You're standing inside a private aviation terminal late on a Tuesday afternoon, not flying, just approving expenses. The jet hasn't moved in days, yet the invoices keep arriving. Hangar fees, crew, standby, insurance renewals. You've paid numbers like this for years. What's different is the hesitation, because earlier that morning, your banker called, not to panic you, just to reassess exposure and review collateral. Calm words, but they land heavier than they used to. You hang up and realize something uncomfortable. You own everything, and yet cash feels tight. At some point, the belief was simple. Once you reached the top, money stress faded away. That was supposed to be the reward. The problems downgraded from survival to logistics. Fast forward to now. The assets are still there. The lifestyle still looks intact. But underneath, the system is straining. Credit is pulling back. Obligations are stacking closer together. And the margin for error is thinner than it's been in decades. If this tension feels familiar, here's the important part. This isn't just a rich person problem. What's happening right now isn't wealthy people losing money. They're going physically, undeniably broke, cash-starved, credit-dependent, and they are simply the first to feel it. My name is Alex, and today we're breaking this down for one reason. Not so you feel bad for the 1%, but so you understand what's quietly moving through the system before it reaches everyone else. Because if you don't see how this collapse works at the top, it's easy to get caught in the spillover without realizing it. If this already feels uncomfortably relevant, tap the like button so the algorithm knows this kind of calm, honest analysis is worth showing. The liquidity illusion when paper wealth stops working. Here's a situation that plays out quietly. Someone owns a large home, has a healthy investment account, and maybe equity in a private business. On paper, their net worth looks impressive. But when an unexpected expense shows up, a tax bill, a legal issue, a family emergency, the response isn't calm. It's calculation. Because very little of that wealth is usable. The house can't be sold without months of disruption. The investments are locked behind market timing, penalties, or collateral agreements. The business equity might be valuable, but it can't be turned into cash on demand. What fills the gap is credit, a line of credit, margin, deferred payment. Over time, this feels normal. Cash is treated as inefficient, assets are treated as safety, and leverage quietly replaces liquidity. That works when conditions are stable, but when rates rise or banks tighten standards, the structure reveals itself. Credit limits get reduced, terms change, calls go unanswered. The same assets that looked protective suddenly feel heavy and immobile. This is how people can look wealthy and still feel trapped. Not because they failed, but because their security depended on systems outside their control. Wealth without liquidity isn't stability. It's a promise that conditions won't change. And eventually, they always do. Buy, borrow, die strategy turns fatal, the leverage trap. For a long time, this strategy was treated as the smart way to live. Someone builds a large position in stocks or business equity. Instead of selling and paying taxes, they borrow against it. The bank is happy. The interest rate is low. The loan funds the house, the lifestyle, the gap between income and spending. At first, it feels clean. Nothing is sold. Taxes are deferred. The asset stays invested. On paper, wealth keeps growing. The danger doesn't show up immediately. It shows up when markets pull back or rates move higher. The value of the collateral drops, but the loan stays the same. Quietly, the bank updates its numbers. Then comes the message asking for more collateral or partial repayment. This is the moment control shifts. The borrower doesn't have spare cash. Selling the asset means locking in losses or breaking long-term plans. And because the asset is often illiquid or restricted, selling isn't even an option. What worked in a zero-rate world breaks in a normal one. The core assumption was that money would stay cheap and markets would stay friendly. When that assumption fails, leverage stops being a tool and becomes a constraint. Borrowing against assets feels sophisticated until timing turns against you. Then it becomes the fastest way to lose flexibility. Commercial real estate, the silent equity shredder. For a long time, commercial real estate felt like the safest corner of wealth. Doctors, lawyers, and business owners were encouraged to put excess capital into office buildings, medical plazas, or small apartment complexes. These weren't speculative plays. They were framed as stable, income-producing assets that outlived market cycles. Here's where the risk hid. Most of these properties were purchased with short-term loans, 5 years, 7 years. The plan was never to pay them off. It was to refinance. As long as rents were steady and rates were low, that worked. Then conditions shifted. Vacancies increased. Remote work reduced demand. At the same time, interest rates rose. When the loan came due, the bank didn't care what the building used to be worth. It cared what it was worth now. Lower income plus higher rates equals a much lower valuation. Suddenly, the loan is larger than the building's value. To refinance, someone has to write a check to cover the gap. Most investors can't. Not because they were reckless, but because the structure never required that much cash before. So the building gets handed back. Years of equity disappear in a single transaction. Commercial real estate didn't fail because it was a bad asset. It failed because leverage turned small changes in occupancy and rates into total equity losses. Lifestyle inflation at the top, the cost of staying rich. At higher income levels, spending doesn't feel reckless. It feels required. A larger home comes with higher standards, better insurance, specialized maintenance, trusted professionals on call. None of this looks like luxury in daily life. It looks like baseline. Here's a common snapshot. Someone moves into a high-end area. The purchase price is manageable. The surprise comes later. Insurance premiums rise after a reassessment. Property taxes adjust upward. Routine repairs now involve specialists who charge multiples of what they used to. Even landscaping and security become fixed line items. Then there's family. Private education costs rise faster than general inflation. Activities, travel, and optional contributions become social expectations. Pulling back doesn't just save money. It signals a change in status, which many people aren't prepared to make. The key issue isn't indulgence, it's rigidity. Once these systems are in place, the spending can't easily be paused. When income dips or investments underperform, the costs keep running, month after month. This is why people with high earnings can feel financially exposed. Their lifestyle requires constant cash flow to sustain. One bad year doesn't feel inconvenient. It feels destabilizing. Wealth becomes fragile when expenses are locked in, but income is variable. And at the top, almost everything is fixed. The illiquidity casino, angel investing in private assets. When money was cheap, patience felt optional. Professionals with excess income were encouraged to move beyond public markets. Private deals sounded smarter, more exclusive. Angel investments, venture funds, private equity. They carried the promise of outsized returns and social credibility. Here's how it usually unfolds. A colleague mentions a startup round. The check size feels reasonable relative to income. The timeline is long, but that's framed as a virtue. You're told real wealth is built by waiting. What gets ignored is access. Once the money goes in, it's locked. There's no exit button, no ability to rebalance. The valuation updates look reassuring, but they don't create cash. When markets tighten, everything freezes at once. IPOs disappear. Acquisitions slow. Companies survive longer than expected, but not well enough to return capital. Down rounds dilute earlier investors. Zombie companies tie up money indefinitely. The investor isn't ruined, they're constrained. This is how portfolios become heavy with assets and light on flexibility. Not through speculation, but through too much confidence in investments that only work when exits are easy. Private assets feel sophisticated. In stressed environments, they behave like a casino where the doors are locked and the chips can't be cashed out. Forced wealth destruction, divorce, taxes, and legal gravity. Most wealth isn't lost gradually. It's lost when timing is taken away. Consider a long marriage ending later in life. On paper, the couple is wealthy. Real estate, investment accounts, business interests, but very little of it is liquid. The court doesn't care. Assets still have to be divided. So decisions get compressed into the worst possible window. A house is sold when buyers are scarce. Investments are liquidated during market weakness. Businesses are valued conservatively because buyers sense urgency. Legal fees accumulate quietly in the background, month after month. The same pressure shows up with taxes. A large tax bill arrives based on last year's income or asset valuation. The cash is due now, even if the income was temporary or the asset value has fallen. There's no allowance for illiquidity. Penalties don't pause for recovery. Then add enforcement. Cross-border reporting, audits, and exit rules are stricter than they used to be. Moving money or changing residency is no longer simple. Mistakes are expensive, and intent doesn't matter much once the process starts. This is how otherwise sound balance sheets unravel. Not because the assets were bad, but because external forces demanded cash at the exact moment cash was unavailable. Wealth doesn't need to disappear to be destroyed. It only needs to be forced into bad timing. The psychological collapse, when status dies before money, this is where the damage accelerates, quietly. When someone has spent decades building wealth, money stops being just a tool. It becomes identity. It's how decisions were justified, how sacrifices were explained, how status was measured. So when the numbers stop behaving, the first response isn't adjustment, it's denial. Here's what that looks like in real life. Expenses stay the same even as income becomes uncertain. Commitments aren't reduced because doing so would signal something is wrong. A short-term loan becomes a permanent solution. Risky decisions feel reasonable because the alternative feels like losing face. Pressure distorts judgment. Instead of stepping back, people double down. They chase one deal to fix everything. They stretch timelines. They smooth numbers. Small compromises turn into patterns that are hard to reverse. Most of this never shows publicly. It looks like stress, defensiveness, and exhaustion. Behind closed doors, it's panic disguised as confidence. This is how financial problems turn into legal ones, not because people are unethical, but because they're trapped between reality and the image they feel forced to protect. The final irony is this: the louder the display of success, the more fragile the situation often is underneath. By the time reality forces change, the cost of pretending has already multiplied. Money can recover, but when identity breaks first, recovery becomes much harder. The bank pullback. When credit quietly changes the rules. This is usually how the collapse actually starts. Not with a headline, not with a crash. With a phone call that feels routine. A banker asks to review exposure. A credit line renewal takes longer than usual. An approval that used to take a day now needs a committee. No one says no. They just slow down. Here's a realistic snapshot. Someone has relied on rolling credit for years. A line of credit bridges uneven income. A margin account smooths cash flow. A refinance is assumed, not questioned. Then the tone changes. More documents are requested. Collateral is revalued. Limits are adjusted temporarily. What's really happening is trust is being recalculated. Banks don't panic publicly. They tighten quietly. They reduce risk before it shows up in data. And when they do, anyone depending on credit feels it immediately. The problem is that many lifestyles, at every income level, are built on the assumption that credit will always be there. Not because people are irresponsible, but because it always has been. When that assumption breaks, nothing moves fast enough to compensate. Assets take time to sell. Income takes time to adjust. Expenses don't pause. This is why collapses cluster. It's not coincidence. It's credit-changing behavior at scale. Liquidity doesn't vanish randomly. It's withdrawn deliberately, long before most people realize the rules have changed. Key takeaways. What's happening at the top isn't a mystery, it's a math problem. For years, wealth was built on the assumption that liquidity would always be available, credit would stay cheap, and assets could always be refinanced or exited on demand. That assumption is breaking. And when it breaks, leverage exposes fragility fast. The lesson isn't that wealth is bad, or that success is a trap. It's that solvency matters more than valuation. Cash matters more than appearances. Flexibility matters more than optimization. The ultra-wealthy are simply feeling this first, because they relied on the system the hardest. The same forces move downward over time. You don't need to predict the economy to protect yourself. You need margin, lower fixed costs, less dependence on borrowed stability, more room to breathe when conditions change. If this breakdown helped you see the system more clearly, tap the like button so more people see analysis that focuses on structure, not hype. And subscribe if you want to understand where the pressure is building next, before it reaches you.